update and technical analysis on Eli Lilly and Company, a company of the healthcare sector and drug manufacturers. Here off the daily interval, and I had mentioned it as a breakdown sell signal off this rising bearish wedge pattern with big negative divergent highs and negative and bearish divergences that have continued to construct and establish themselves on all three indicators going back as far as September of 2021. And I had issued that sell signal. Here is the before photo. I'd mentioned it at 361.79 spot price, December 11th, 2022, where we put in that solid daily candle close off this rising wedge pattern. Had that classic look of a head and shoulder, head and shoulder top. So the minor primary uptrend line acted as the neckline to this head and shoulder here, and we snapped it. That's when I issued that sell signal. I had a 345.42 target with a 340.92 spot price gap support there, and those have completely been breached now. 361.79. So we'll see. The entire trade thus far has been good for call it a 5.4% drop here, and we are at a pretty key inflection point here with a thin now trading within a thin volume price zone, coinciding within the bottom of this neckline, or this new neckline of this head and shoulder, where we have an offset style head and shoulder, and now we have that confirmed. Take away the lines here, beautiful head and shoulder, classic looking top here with the neckline. And here we are at a pretty big inflection point. Tire trade, bull traders, dip buyers, they want to step in right here and defend that 340.92 price support at all cost. With the thin volume profile zone at the bottom of this neckline, and these bearish head and shoulder formations, and the gap support at 340.92. This is definitely an aggressive long trade set entry, and a snap low of this neckline will undoubtedly revive renewed damage to our key momentum indicators, with potential for a more rapid pace of selling, in my opinion. So I want to zoom out to the weekly interval. This is the weekly interval, much larger picture. We have this October crash reactionary low here, really off it's a major uptrend line. This is big support here off the weekly, and we are starting to breach it now. And there's a potential for a whipsaw reaction where bull traders and long traders whipsaw that right back up above. But this 2020 crash, was off the drug makers' disappointing third quarter earnings report, and just a key inflection point again. And if we start to crack that neckline, I would expect more selling down at least back to that key secondary benefit of doubt minor trend line, coinciding with the 50 weekly moving average support there. So that would be a typical closeout. Now, if we snap that and put in a solid candle stick close, weekly close below that, I would expect a pretty extreme rush for the exits, and 296.22 would have to be defended at all costs right there. That is a big support there. Call it a big major inflection point. And if we snap that, that would give us a secondary sell signal, in my opinion, and maybe a much larger wave of selling. Anything's possible. Anything could expel further. But here we are. We're 329. Let's call it 329.31 as that big key inflection point. If we do revisit that trend line, and all traders will have an eye on that on a complete backfill the gap to 312.99. But this is where it's at. You want to see, as you've seen, I've added this new key primary downtrend line as well, and usually it's revisited and tapped, going back all the way up, as you can see here, where we had a complete tap, came back down, had another counter trend rally, tapped it again, and as you can tell, it's starting to get shy of tapping that primary downtrend line now. Now, if we do have that a renewed counter trend rally here, it would offer an objective short trade entry off that 361 zone, coinciding with the 50-day moving average up above, and a breakout above is what the bulls want to see. Long traders want to see that, and potential start getting squeezed out and start to close your short trade position and getting stopped out. But a revisit that's a little bit lower of a chop, rather than actually revisiting that primary downtrend line, is just even more bearish especially if the chop is not that big of a counter trend rally. And if we start to edge a little bit lower like that, that is just more bearish, technically speaking, with which we will have confirmed um, more indicator damage to as well. So you want to see a huge, healthy bounce right back up to that downtrend line, um, offering an objective short trade entry. And the lower the chop, the more bearish the trend.